Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype right to the heart of the big issues of the day. This week we're wrapping up our short, occasional series looking back at the recent 2025 UBS European Conference. In these shows, we've picked out a few of the key panels, themes and talking points to explore in greater depth. We kicked off the season discussing data as a differentiator. Then we took a deeper dive into markets and trading. And to conclude the series, this week we're talking about central banks. Here to share their thoughts and insights, we welcome back to the programme Jonathan Pingle, Chief US Economist, and Anna Titareva, European and UK Economist. And we also welcome to the show Eleanor Amoruso, Rates Strategist at UBS. Let's kick things off with you, Jonathan. Always great to have you on the show. Just reflect first up, if you will, on the recent conference, and in particular, Jonathan, what the discourse was when it comes to the central bank landscape. What were the key themes around the conference?
So if I look back at the conference, I think there was a certain amount of bullishness about U.S. growth, and in fact, I think global growth in general. And I think the relevant sort of spillover into thinking about central banks, with that backdrop was, a certain amount of skepticism about certainly how much more easing would come out of the Federal Reserve, as well as, people asking, whether or not, ECB or other central banks that, have generally eased as inflation has fallen since the pandemic are now done or, at some point may have to raise rates.
Let's kind of throw things forward then if we look into 2026. What, Jonathan, in your view, are some of the kind of key, tensions, facets, factors that are shaping the central bank narrative? If we look at the US picture in particular, I think we probably can imagine some of the things you might cover, but just mention a couple of the sort of the key forces that are acting on this space.
I mean, for 2026, one of the key tensions in the U.S. is really going to be between fiscal policy and tariffs. The tariff pass-through has been, I think, shallower than most people expected, but it's not zero, right? I mean, we are still seeing this incremental pass-through prices into goods inflation in the U.S., and that's weighing on real incomes and consumers and some households, raising business costs. And it's probably one of the reasons that the labor market has slowed in the U.S. In contrast, we are expecting the more meaningful impact of the White House's One Big Beautiful Bill Act to show up next year, particularly starting in the second quarter with a relatively strong tax refund season, literally checks being sent to households claiming refunds on, their 2025 income. And I think that sort of headwind versus strength narrative is going to be a sort of key thing for the central bank as 2026 plays out. Does inflation remain elevated? Some of the news on inflation has actually been quite favorable for the FOMC. Does growth really reaccelerate to the extent they expect, or does it disappoint and the labor market stay weak? So, I do think there's probably more uncertainty than is found in the sort of relatively, I think, consolidated consensus that we're going to see acceleration next year. And I think how these two forces of the tariffs versus fiscal policy boost will really be key for monetary policy and the evolution of the economy next year.
It's really interesting, actually. Just prompts me to ask you a final question, which is on some of these topics that we've discussed before on the programme, which is about the sort of collateral damage from trade disputes, general kind of uncertainty around certain policy directions, and of course, just volatility generally and how challenging that can be. From what you say there, are you sort of fairly bullish then that we can kind of get those things out of the way, get more excited about that acceleration you mentioned, or do we just need to kind of take one thing at a time?
I mean, that's sort of the central question. I think we sort of need to take one thing at a time. But I mean, there is sort of this sense where it's like, if trade policy uncertainty, if the noise and the volatility could get out of the way, there are some bright spots to support more solid expansion.
Well, let's kind of skip across the pond. And Anna, let me bring you in here. If we sort of get a bit of the European economic outlook, I guess there's some kind of narratives that might ring a little familiar. We could see growth, a bit of acceleration, potentially. Give us a sense, again, what were people talking about at the conference and what you heard there change how you were looking ahead to 2026?
So I would echo a bit of what Jonathan mentioned about the U.S. outlook and in particular fiscal policy. That's going to be one of the key factors for the Eurozone growth outlook over the next 2 years. The way we describe it is that we have 2 good years in terms of growth ahead of us, given very significant fiscal stimulus that's coming largely through Germany, but also broader EU when we think about defense spending in particular. However, if I look back at our European conference, actually the sentiment was rather skeptical. And essentially, there are increasing questions about how effectively the German government will be able to deliver fiscal stimulus and spend the money, and essentially how much of a growth boost it's going to provide. So we remain, I would say, more constructive, but in terms of the investor base, does seem to be a rising skepticism around the growth impact of the fiscal stimulus.
And it's funny, you mentioned Germany there, and the stats, it looks like a broadly kind of stagnatory picture at present. But my understanding is that there's an anticipation that Germany can kind of move forwards and be a kind of a leader in growth for the bloc by 2027?
Our punchline in the outlook was that Germany is going to move from being a growth laggard to a growth leader by 2027. And this is on the back of a significant fiscal stimulus. You mentioned stagnation in Germany. It is the case that essentially we've seen stagnation over the last 5 years. And, looking ahead, we do expect growth to pick up. And also, sort of going back to my point about skepticism, potentially part of this, quite cautious sentiment around Germany is that the announcement of fiscal stimulus came early this year in February. We are now at the end of the year. And so far, we haven't seen that fiscal stimulus essentially being reflected in German growth numbers. But for us, it's not yet sort of a warning sign, first of all, because the German economy and broader European economy is still working through its way through the U.S. tariff shock. And secondly, we've always said that, the fiscal stimulus in Germany is going to take time. It's going to take time for all the approvals to take place, also essentially for a lot of projects to kick off. So we do acknowledge that so far the data and growth in Germany still looks quite subdued, but we're still quite optimistic that going into the next year, and in particular around Q1, Q2 next year, we should start seeing growth picking up.
Really interesting stuff. Now, before we turn to Eleanor and hear more about the Deep Speak, I was actually just going to ask you quickly, Anna, to help us put this in context, because when it comes to looking at, whichever market it might be, the Fed or ECB, BOJ, looking at central banks, that idea of trying to get a sense of sentiment, of the tone of the discourse and rhetoric, I guess that's always quite a challenge. So before we hear more about the tools, can you tell us a bit about the challenge of making sense of those tonal things, the language, the sentiment, and maybe that will help us understand why we have some of these new tools potentially to call upon. Tell us about the challenge of understanding that sentiment and those tones across those different markets.
When you look at for example, the Fed, the ECB, the Bank of England, the sort of structure of either the Monetary Policy Committee or the board differs depending on the region. In comparing, for example, the European Central Bank or with the Bank of England, the European Central Bank tends to be more sort of consensus building, whereas with the Bank of England, you clearly see 9 different opinions of MPC members. So in terms of gauging direction of travel and where the sentiment is shifting within the either MPC or the Governing Council, it's very important to be able to pick up on small things from various speeches, interviews, news snippets, and see, whether there are any sentiment shifts. And, what Eleanor's models look at also sentiment shifts around specific areas, either growth or inflation. So in that sense, these tools make our job a bit easier.
Let's hear a bit more about it. Eleanor, it's great to have you with us. That's the kind of the need. Tell us about what you've been working on and how it can help to enhance understanding and give more options to colleagues to ensure they're delivering for clients.
Yes, so we've been working on an AI tool based off LLMs to track basically central bank language in a very granular way, meaning that, as Anna was mentioning, we decompose our sentiment indexes by topic and by speaker. This means that our output is not only a daily tracker of how the tide moves of sentiment, but also a tool to dig deeper into what's driving the sentiment shift. This can help us, for example, in understanding even if we do a qualitative analysis as analysts, this tool tells us what you should be paying attention to. terms of speaker or topic. Now, it's been an endeavor that many people have tried for like 20 or 30 years, obviously, given the relevance of this data set for global markets. The issue before the 2020s was that all the natural language processing tools that we had before work based on keywords. And central bank language is notoriously very nuanced and conditional. And this is where LLM came in due to their ability to decode what's called the semantics and context. We've noticed that our indexes, a bit more for the Fed and the ECB and a bit less for the BOJ, due also to historical reasons, have also some predictive value over the short end of rates. So that's a tool that also can be used quantitatively and not only as a qualitative add. In fact, we also have an API to download the data and to track daily to feed, for example, into existing models as an additional feature.
Tell me a little bit about how the model actually works, Eleanor. What are the mechanics?
So we start with parsing from the official Board of Governors website, speeches, and press conferences, including the Q&A for the Fed. And then we split them into sentence-by-sentence blocks. After that, we pass them through a 3-stage LLM pipeline. I was mentioning before that our approach is very granular because you cannot afford to make the sort of very global statement that you would do, for example, if you feed an entire speech to something like ChatGPT and ask for an hawkish or dovish answer. So the first layer of our modeling is the topic classifier, which tells us basically which topic is the sentence about, and we only keep those topics that are relevant for gauging the stance of monetary policy based on basic economic intuition. So we're talking about inflation, employment, balance sheet, and interest rates forward guidance, of course. Then the sentences that pass this first stage, so that belong to one of these 5 topics, get into the second layer of the model, which determines whether they also imply or contain a directional stance. Because, of course, it matters whether something like the staff reviewed price projections is a sentence about inflation, but it doesn't tell us anything about what the central bankers is implying with that sentence, whereas inflation is going up is clearly directional and can have implications. That subset of sentences that passes through the second stage finally gets to the core of the model, which determines sentiment on a 5-point scale from explicitly dovish to explicitly hawkish, allowing also mixed statement in the middle. After that, we simply use weighted formula to aggregate these sentence scores into a daily index.
Yeah, I mean, it's fascinating mechanics. And maybe actually, Jonathan Pingler, if I bring you back in now, Eleanor was saying there about, 20 years, it's been this sort of ambition to try and deliver this kind of resource. It must be incredible. I don't know, it must be really exciting to get to tap into this kind of information that was maybe not that long ago, really beyond just, it was a figment of people's imaginations almost.
It's an incredible resource. I mean, Eleanor's done a phenomenal job putting this together for us. I mean, I remember back in the day where I would do word counts just to try to establish something out of text. And I also remember, before we had good search, doing it by hand because I'm that old. But no, what we put together is really great. And it actually comes up with, some pretty interesting comparisons because you can get the breakdown across the governors and you can really see, sort of the direction and shifts in their language. That's, really actually, if you think about it this year, despite a number of round trips in market pricing, it's done a reasonably good job of, sort of getting ahead of, when you were going to see policymakers move forward, and follow up on the language that they were using. It's also been interesting too, because the way it's constructed, by design, I think to some extent separates the wheat from the chaff, probably the wrong metaphor, but, it does make us hone in on sort of the core of the committee that's really sort of driving the bus on monetary policy as well. But, it certainly proved to be a pretty rich, pretty interesting, pretty useful analytical tool.
Jonathan Pingel wrapping up this edition of the show here on Monocle Radio. Head to monocle.com for more, including offers and info on subscribing to Monocle magazine. And as always, you can discover more and find out how UBS can help you at ubs.com. This is The Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.